Fiduciary Radio for a really great future. We're talking real money.
Wow, today we're really talking. We're talking real money today. We're talking about something that so many of you will at some point, if you end up with a little extra money in your pocket, may find yourself facing. And I want to welcome you to the podcast. Yes, it's the post-Christmas edition of the Talking Real Money podcast. I'm Don McDonald along with Tom Cock, and you're there. You're whoever you are, and we're glad you are who you are. And we're glad you're not Kyle Busch.
Just be glad you're not, Kyle. Good old number 8 is, wow, he's plummeting to the bottom. He's hitting the boards there. It's not good.
No, I mean, come on. Kyle's done really well driving race cars around oval tracks for many years. But the fact is that rich people get taken just like regular people by unscrutable, slightly dishonest. I just have to say that. I mean, I could say blatantly dishonest, but let's say slightly dishonest insurance salespeople. And these folks are legion. We've talked about, in the past, we talked about Northwestern mutual agents and how they're hard selling whole life and all this stuff. Well, Kyle Busch and his wife were sold one of these things. We've talked before about the bank on yourself programs that
you don't hear as much about it today as you used to, though.
No, but they're still out there where you can put money into an investment that behaves like the stock market, protects you 100% on the downside, and gives you a wonderful income tax-free for the rest of your life. They're called Indexed Universal Life policies.
Index Universal Life, yeah.
And this is what the Busch family bought. They bought into an Indexed Universal Life policy from the folks at Pacific Life, and it didn't turn out the way they expected.
And how big was the policies? Like what, $10 million or something, right?
Well, the premium. We're talking about the premiums. This is the premiums they've been paying in. They paid in like $10.5 million in premiums. Now they're rich; they can afford that. But they were promised. They say in their lawsuit against Pacific Life, they were promised after 5 years of premiums paid, $800,000 a year in tax-free income.
Okay, but let's explain the product first, because it is a life insurance product, correct?
Oh, absolutely. So it is not an investment product.
Dead. Yeah.
There is no SEC or FINRA regulation. The only regulation for these is at the level of state insurance commissions, notoriously lackadaisical in their regulation.
And that shows here, right? Okay, so this is a life insurance product, but it has a cash value attached to it. That's the part you're talking about, where you pay into this, and then years later it's going to pay out, or is it?
Well, no, what you're doing is you're borrowing.
You're
not getting a payment. You're borrowing your cash value. That's how it's, quote, tax-free. And I'm using air quotes. I know this is a podcast, but air quotes.
And why is he upset? Because he's paid the $10.5 million in premiums. Mm-hmm. He's too young to draw from this yet, right? And is he still the Candyman, the Wild Thing, whatever his nickname is today? He's still driving, no? I mean, I don't follow NASCAR, obviously.
I honestly
somebody's
don't
going
know.
to write me.
I didn't check that. I checked a lot of stuff for this story, but not whether he was still driving.
Yeah, because I think he's only in his 40s or something. Not that
50s,
old. 50s. Okay. So, but was he expecting to pay? In other words,
yes, he
what
was
precipitated
to
the
start
lawsuit?
taking money out.
Okay.
Okay, he was expecting to take money out after 5 years of premiums paid. What gave it away how the jig came up was he got a 6th premium notice when it was supposed to be 5 premiums, and then he was paid up. He got a 6th. And so he took it to a real live fiduciary CFP financial planner person, and they went, oh, yeah, if you don't pay this premium within 16 months, your $10.5 million in premiums vanishes completely.
Completely. Because you have to
Completely.
keep it up to date.
You have to keep the policy up or everything goes away. So Kyle went, well, I think it's time to get the attorneys involved. I
So
tried
they've
to
sued.
make it sound like I'm a little.
Sound country. They've sued Pacific Life.
Yeah.
Wild Thing is showing his wild side here, I guess, or not. He just realizes he woke up and realized this was not the deal that he thought he had signed up for. So this is still working its way through the courts. There's been no resolution. But I think for most people, the lure of what you said at the beginning. I mean, this idea that you get this tax-free income. It's awesome.
You get tax-free income. You get the returns of the stock market with none of the risk. You're absolutely protected on the downside. What more could you possibly want? It sounds like the perfect investment. Tax-free income, high returns, no risk. It's what every investor wants. But the problem is it's a lie. I can't emphasize this enough. Please listen to this. No matter what these idiots and incompetents and nincompoops and jerks say, this is a lie. It's an inherent lie because they don't disclose all of the bad parts because there is no national regulation of insurance products.
They can get away with it. And the people that peddle these products are highly incentivized to the tune of, did you say like $3 million commission or something? I mean, on this product?
Well, in their lawsuit, they claim that the commission paid was 35% of the money paid into the policy. 35%. Now, I cannot independently verify that, and I tried to do so because all of the commission disclosure documents are for professional use only. In other words, you must be a licensed sales agent with Pacific Life to see how much you're going to get paid by Pacific Life. There is no public requirement that this be disclosed. That alone is appalling.
Okay, so where are we today? This is just recently came to light because the lawsuit was filed. But the product itself, it feels very complicated to me. Would that be true?
That is 100% true. It's
And so you're
designed
putting
to
money
be
in.
complicated.
And are they investing this money for you then, the cash value
They are
part?
investing it for them.
Okay.
They have the money. They provide you as the client, the mark. They provide you with a return that is based on a convoluted, complicated, not publicly accessible, wacky index that they've created specifically for the purpose of working within their actuarial tables and their math to make sure they make lots of money and you don't.
And this, I'm assuming, has some sort of cap to the return. You get part of this. It's
percentages. Yeah. And it's really interesting because I found an internal document from Pacific Life that was their Horizon Index Universal Life 2. And within that, it says it was filed as a public PDF online. They messed up, but it says for financial professional use only, not for use with the public. Now, get this. Here's
and
what
yet
it says.
the public can read it.
Because they put it in the wrong place.
Oops.
In the document, it says, don't call yourself a financial planner or imply that compensation is unrelated to sales. Don't imply that.
They say that, but they don't do that, of course.
Right,
they all
right.
call
You see, they're covering their derriere in their documents. So don't say this. It's kind of like when I was a broker and we were selling no front load funds and we were told we could say they were no load with our mouths, but never put it in writing.
No, never put it on
Don't
paper.
put it in writing.
So it's
wait, hold
complicated.
on. Don't call yourself a financial professional.
Nope.
Don't sell life insurance as an investment plan or a private pension, which is exactly how they sell them. And then they talk about commissions, but they intentionally keep the commission schedule from any consumer-facing material and out of all of their illustrations, so you cannot know how much you're paying to them.
That was part two, because this is very complicated product. The cost. So, I mean, there's a cost of the insurance, obviously, right? You got to pay something, and especially for somebody like Kyle. I mean, he's got to be, that's a risky business he's in, fairly, expensive to insure him. But the cost of the money that goes into this cash value, is there a way to determine what you're actually paying for all this management?
Nope.
No way to do that.
None of that is disclosed. Commissions are hidden. Cost of insurance is opaque, and it changes. The agent's compensation structure is really just between, and it can be adjusted, by the way, from agent to agent. The illustrations exclude all of the cost information, unless you're a producer. There's no SEC filing. And the insurance commissioners allow for literally no. If you bought a mutual fund, you have to get a prospectus that spells out the risks. There are no prospectuses. There are no standardized return assumptions. The SEC has those. There is no disclosure about the expenses. There's no, they don't tell you what they're crediting to your account. To your question, it's not there.
And so at the end of the day, because I did do a little looking at Index Universal Life as a product and tried to find out what sort of returns people have gotten from, and I can't find anything.
I have, and the actual returns have ranged between 3% and 5% a year.
That sounds like the return of the market, isn't it? That's about what the market provides.
Yeah, that's about
half
what the market provides, or less. But here's the thing: if they told the truth about these products, if they told you everything about them, no one would buy them. They would go away. Literally, they would go away, because no one would buy something if they knew that, well, a third of everything you're paying in is going to pay the agent, and then we have to take a profit, and then you go, wait, the math doesn't work.
No, it does not work, clearly. So, okay, so going back, Kyle has a young family. I did look that up. So he is somebody who should have life insurance, term insurance of some kind. He should be investing for his future. I'm assuming he's doing that. He's been a big earner separately from an insurance policy, correct? And this is the kind of thing, any insurance, in my mind, because I think we had a call about this recently, should be reviewed annually, especially with a young family, and you're looking at trying to figure out, make sure you have the proper amounts to take care of those you might leave behind. But this is not a good product that I can see in any way, the complications, the expense, and the limited returns.
You're so much nicer than I am.
This
is a horrible product for anybody, anywhere, anytime. And by the way, I'm going to take exception to your assertion that he should have life insurance. Kyle Busch is
how much is he worth?
$80 million.
Then, he's okay. He's self-insured.
He's
insured, but he's self-insured.
His family will be fine. If he dies in a car wreck or of cancer, his family is going to be fine.
And did you look up whether he's still driving or not? Because I hate to sound like somebody's such a rube when it comes to NASCAR driving, because I don't. Last driver I knew was a guy named Ricky Bobby, I think.
He continues to. He's signed up for 2026.
Okay,
so he's on the circuit in 2026.
Right. Good for him.
Yes.
Yeah. So, buyer beware. Caveat emptor. Happy holidays.
Actually, if the person you're talking to works for a firm with the word life in the name of the company, you should just run away as fast as your legs will carry you.
All right, let's go to the questions.
Questions.
Hopefully that's quickly as we get close to the new year here. Tony from Portland, Oregon. My wife and I are almost 51 together. We make about $340,000, have maxed out our 401ks each year prior to turning 50. We have about $2 million. Mostly invested in 401ks. We made adjustments to put 60%, here's the important part, 60% in an S&P 500 fund, 15% in an international index, and 25% in a safe bond fund. My question, are we diversified enough? Also, should I put some of the dollars I invest in the 401k to the 401k Roth option? Then he talks about his health, and he does have insurance, et cetera. But to me, it's about the portfolio design. Right now, 60% in large U.S., 15% international, 25% in bonds.
No. This is not well diversified at all.
No.
One, First off, way too little international. Way. I know you're America first. No, more in international. 2, you have the S&P 500. We were on the quest to stop people from thinking the Dow is the market. And I think we've done reasonably well with that. The S&P 500 is also not the market. It's not.
Especially in light of the fact that a third of it's made up of 7 stocks.
Yeah. So you either need to do one of two things. You either need to go with sort of a target date product that has a value and small cap tilt that is globally invested. You could do that with Dimensional. You could do that with Avantis. Or you need to skip the S&P 500 and get for the 75% of your portfolio that's in equities, just get a total market index fund like AVGE or DFAW, an ETF, and then 25% in bonds, however you're doing that.
Yeah, I came up with this: 35% in the S&P 500, 20% in small, and 20% in international, and then the rest in the bonds, so that you have more balance to the portfolio. By the way, we just learned again yesterday in a class from Dimensional Funds that for the last 10 years, U.S. small cap value, the best performer. You might have thought it was the S&P 500, but it hasn't been. So interesting.
Or yesterday was Sunday, so Tom is attending special meetings.
I'm working, man. I'm working it.
No, I like my idea better because it's easier. AVGE or DFAW and a bond fund. Yep. Done.
There you go.
Make it simple. Why do we try to make this so complicated? We are not managing the Harvard endowment, folks. This is
wait,
in the grand scheme of
things. Did you just raise Harvard? Wait, and you know we're the crypto boys. Come on,
we did that already.
Okay, but still,
but the reality is, we're overthinking it. We tend to overthink it because we think, well, it must be complicated because it's investing, so I have to complicate it more. I need to do more. No, do less.
And make it happen.
Less hard on this.
Gainesville, Florida. John writes us, hey, longtime listener, thank you for keeping me, age 70, on track financially. Thank you, John, for figuring out how to do a podcast at age 70. I run into a lot of my colleagues who say I don't even know how that works. So my contemporaries.
Look, here's what I want you to do next time.
Please.
Look at them and see if they have in their hand or their pocket, probably in their hand while you're talking to them, an iPhone or other smartphone.
And it's right there. It's one of the apps that shows up right on the front.
If they have one,
you push the button.
Go, dude, let me show you something. Unlock your phone, and then just go up to the top and type in podcast.
Yeah,
and there'll be an app.
Usually it's an app that shows up there. So okay, thank you, John, for that. He says I appreciate your advice laced with humor and banter. Life's too short. I missed last year's seminar. Do you have a date yet for 2026 so that I can make plans? Thanks, John.
He's coming from Gainesville?
Well, you can watch online. A lot of people do that.
Could watch online. Yeah, people do watch it online. I don't know. When's the date? It's in March this year.
I'm quizzing you to see if you remember the date or not.
It's the first Saturday in March. That's
coming up now. March 7th, 2026. And in a few days, you'll be able to sign up for it.
Oh, look, March 7th, 2026. There it is.
There you go. So we'd love to have you be part of it.
This is how much attention I don't pay.
Apparently not.
You just tell me where to go and I'll get there.
You'll be there. Hillsboro, and you don't. Hopefully, it won't be freezing and snowy and ice like the last couple of years. No, not in March. Hillsboro, Virginia. Brian writes us, good afternoon, gentlemen. Thank you for all you do to educate us about real money topics. I've been an avid listener for the past years, and after hearing an ad on the Clark Howard podcast. Currently a high school teacher, 5 years remaining until I can retire with a nice pension. However, I'll only be 53 years old. I have been very interested in personal finance and financial planning for a long time. I feel like 53 would be too old for me to begin the process of becoming a CFP, but I've been reading about becoming an AFC, which I don't know what that is.
Isn't that a football player?
Yeah, it's somebody plays in the old American Football League. I wanted to get your thoughts on whether this is a real designation that holds weight in the financial profession or just a money grab to buy a certification. I think it might be the latter. I want to be able to help people.
Financial counselor.
Yeah.
Oh, I'd never heard of this
Me
one.
either. It's an alphabet soup. It would have no comparison whatsoever to the CFP. And by the way, I want to be able to help people with a brighter future, et cetera. My plan is to work in some capacity till age 65. Look, if I wanted to give people actual real advice and get paid for it, I'd just go get my Series 65. That's easy.
Right. You don't have to be a CFP.
No. I mean, I think that's the gold standard. I think you do know more if you have gone through all that training. Sure. But you don't have to do that. And then you got to kind of decide, Brian, whether you're actually going to do this as a real job, whether you're just going to talk to people. I mean, there's a fork in the road there, right, Don?
Yeah, and I'm looking through the AFC standards, and actually it's not as stringent as CFP, but it looks like it's a decent designation. I don't know how you make money in it. You'd have to just charge people by the hour, and I'm not sure what the registration
Well, you'd still have to get the
requirements-
65 if you're going to charge people.
Yeah, if you're going to charge people, you'd have to have the 65. So I don't know what benefit it gives you. What I would probably do, is just go get the book, or there are online courses on the Series 65.
Yep.
And do those. See if you find it interesting enough to pursue that, because that's relatively easy to get. 53? 52?
53.
Wow.
Yeah,
53.
young guy. Yeah.
That's
He'll
not
be 53 when he quits. Yeah.
I mean, that's not too old to get a CFP.
No, and that's not too old to work in our industry. Just talk to a guy in
absolutely
Texas
not.
who's doing that. Yeah.
Yeah, if you work for a really great fiduciary firm, it is a very satisfying, non-sales oriented job. If you work for most of the firms in the industry, you're just going to become a highfalutin cold calling salesman.
Yeah. And here's the other good news. There's a lot of old guys.
Mm-hmm.
See these two that are on the way out. And so at 50, they might say,
I gotta
we
go.
hire you for 15 years. Yeah, by the end of the show. So they might say, there's a lot of firms that are hiring right now because there is a shortage of financial advisors. So if you really wanted to be a financial advisor, go get the 65 and then call people and say, I have a 65 and I'm interested in working the business. Some may hire you and train you up. Some may say, forget it. It's hard to know.
90% of the people who will show an interest in you, maybe 95%, are going to be schlock shops.
Well, but only go to work for 100% RAA. Don't work with anybody else.
Who has?
Be selective.
If they're duly registered,
no,
don't work with them. Don't.
No, you'll be tempted because they'll say we can get you right in here.
They'll make it very attractive financially initially. See Northwestern Mutual.
And they're going to want you to open your phone and spill out all the names and addresses too. Oh, maybe the phone numbers as well. All right, time for one more question. Squeeze one more in.
Yeah, we have plenty of time. Yeah.
From Dorothy in Washington State. She says, what criteria or URL do you recommend that elderly couple use in selecting ETFs if moderate growth, low risk, and tax efficiency are the goals? Moderate growth, low risk, and tax efficiency. Tax efficiency is pretty easy, actually, because
that's an
ETFs, you get rid of the capital gains. That helps.
The realized capital gains. Don't make it sound like you get rid of capital gains.
No, you don't get rid of capital gains, the realized capital gains. So that
realized
cleans that up.
capital gains for as long as you hold the ETF.
Correct.
What's she looking for, a resource?
Moderate growth and low risk. First of all, those are a bit contrasting because if you're going to grow something, you have to take risk to do that.
Yeah, that actually kind of goes back to our Kyle Busch conversation.
It does.
Because Kyle wanted
and eat it.
Return to the market with no risk. And he was promised that, but it doesn't exist. So what you have to do is decide which of those is the more important aspect of the investments. And one way to do that, you want a URL, go to talkingrealmoney.com and then click on the risk quiz and take that and find out what your allocation might need to be between stocks and bonds.
Bonds. Okay, but then after that, how do you go to what website would you recommend to go pick funds? That's the question.
Yeah, Morningstar is going to be a little too complicated Morningstar is not going to be a good resource for lay people because you're going to be tempted to look at 5-star funds and you're going to get into active management and it's going to be so confusing. It's just going to be confusing. So that's why we try to, even though we know there are other funds out there, There are some from iShares. There are some from Fidelity.
Sure.
But we generally tend to go with suggesting Dimensional or Avantis because they give what we think is important, which is a value in small cap tilt. You can find a fund that will fit your risk tolerance, or maybe two funds within those groups. But generally, you can find a fund that's going to come pretty close in terms of balance because of target date products and the like. So I would just use those two resources. Dimensional.
I think those are good. Yeah, good resources. You're right. If you get into Morningstar, you're going to get too deep in the weeds and maybe a lack of understanding. By the way, two things from Dimensional that we just learned. Number one, the balanced funds that, they have like a 25, 75, 25% stock, 75% in.
Yeah, now those are funds, though, not ETFs.
Well, I was getting
Are they
to
making
that.
them
So they're
into
never going to be ETFs. They told us yesterday because they can't make that arrangement. So that's never going to happen. Part two, they have been approved to convert all the other funds into ETF, the mutual funds into ETFs, but it could take a year. I was surprised when they said it'd be that long, but it could be.
Oh, because there's a ton of regulatory stuff.
Yeah, so it's a lot of work, but that's coming. So, yeah, I like your ideas. So keep it simple. Go to a couple fund families. And, yes, you could still use Vanguard or iShares. Those are both very fine fund families as well, of course.
Yeah. All right.
That's all I got, man. Survive the holidays, survive the podcast. I'm in a good place.
Did you really survive? I mean, you're not looking too good. I mean,
I know, as you well know.
Yeah. Anyway, thanks for being a part of the program. If you have questions, go to talkingrealmoney.com, click on the contact form, send them in to us because we love answering those. If you speak them, they go to the Friday podcast. If you type them, then they're going to show up on another podcast. And if, like, for example, the person we were just corresponding with, if you want somebody to kind of help you figure out what kind of a portfolio you should build, and you don't want to pay someone, you don't want to hire them necessarily, you just want a few minutes, you want a half an hour. Here's something we've been doing since 2009. That is provide our Appella advisors, not all of them, some of them, to you for free.
The good ones.
Yeah, the good ones, the intelligent ones, the
Smart.
good-looking ones. We're going to give them to you. We're going to give them to you for free. We're just going to hand you a person for a few minutes. You can't have them forever. You got to give them back, and there will be no charge or high-pressure sales pitch. Promise. Okay. Go to talkingrealmoney.com and click on what is it, Tom?
Contact us.
No, meet an
advisor. Either one will probably work, but meet an advisor is correct. So, I'll get it right in 2026. Does that make you feel better?
Well, that's like any minute now. So
I know.
We're hoping for that. Thanks for listening. Happy New Year, and join us in the new year as we continue talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.